This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get on to our chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Mike Green's picture that says, Looking for the Downloads. Now, Nick, great to have you back on the show here, buddy. Let's talk some of these charts. On page 2, I started by putting the S&P 500, and I wanted to look at some of these levels. But what are you watching in terms of the open interest and activity out there?
Yeah, Patrick. Well, right now I'm looking at the SPX spot, which is 39.15, November 18th OPEX, which is tomorrow. Currently, the expected move is pricing in about a 1.5% move in either direction, about 60 points. The upper expected move is about 39.75. Again, resistance there is around 4,000. This past week, we hit that about 3 times and rejected every time. So I expect to move lower here. A lower expected move for tomorrow is 38.55 and supports around 3,800 right there. Now, Eric, what do you think about the S&P here?
Well, as I've said before, my only strong conviction is medium to longer term in the sense that I don't think the final bottom is in, and I still think there's plenty of bad news to come for both markets and the global economy. In terms of here and now, the chart looks to be rolling over or at least taking a pause before tackling round number resistance at 4,000 on the S&P. So I do think we're at a short-term fork in the road and that it makes sense to expect the market to either fail here or break higher through 4,000 and then at least test the 200-day moving average at 4,071 if it does break above 4,000. But whether it's going to break above 4,000 or fail below 4,000, frankly, I don't have any strong view.
Yeah, Eric, it's interesting because I am looking at similar levels. So on the chart, I marked with a red line that 4,000 level, and I conveniently also put the 3,900 level on there, which is very close to where fib retracements on hourly charts all lie. And in my mind, the S&P coming to this 4,000 level, which is where the fib zones are, and like you're saying, the 200-day moving average is sitting right above there. We're overdue for just the rally to be checked. But I don't want to already start to think bearishly about this. While I do believe we're in a bigger bear market, and we'll talk about it on the next chart, I don't see any reason why November is going to be where something more ominous would start. And so my first way of approaching this market is that while we can easily get to 3850 or 3900 during this little pullback, the initial dip should be bought by participants, and we could easily be heading right up towards, well, conveniently, that 4,071 level where you were just talking about that moving average is in there. I wouldn't be surprised if we would be in the first or second week of December still muddling along this 4,000 level above and below, and that a bigger move of conviction is going to have to probably wait for the new year. And that's where on page 4, I wanted to just segue to the weekly version of this S&P chart. And really what I wanted to highlight was that for all of the bearishness, fine, there was huge carnage in the tech industry and many of those FANG stocks, and there was certainly carnage in the bond markets. But when you put it into a bigger picture context, we barely gave back 50% of the rally from 2020 up to 2021. We saw a more than 100% rise in the S&P that went 2,600 S&P points. And so while this bear market has been a challenge, it's hard to call this a bear market yet when all we've done is given back half of the previous couple years of gains. And this is where the bigger question I think to solve in the coming new year is that is there another leg leg of a bear market coming. And that is one of the puzzle pieces that we're a big picture trading trying to solve. On page 3, just skipping back a little bit here, though, I have the NASDAQ, and I wanted to just briefly touch on this because to me, obviously, there was a big snap higher in many of the FANG stocks, and some of the different semiconductors moved nicely. But overall, the NASDAQ has been and continues to be an underperformer on a relative basis. There continues to be a lot of distribution in this space. And for me, I don't see a reason why NASDAQ should come back as leadership in this cycle. And so while some people are getting attracted back to many of the traditional names that worked so well in the previous decade, like those FANG stocks, I think it's very likely that we're going to see, a period where other sectors are going to continue to lead. Nonetheless, I think that the NASDAQ is going to have a very hard time beating that kind of 12,000 to 12,500 zone in the coming month. Now, Nick, I know you track the QQQs because that's where all the big options activity is, but what levels are you keeping an eye on there?
Yeah, Patrick. So as you were saying, we've had many rallies this year, small rallies, and the largest one we had was about 24% on Qs from the June lows all the way to the August highs in the summertime. We've had a few subsequent rallies of about 7%, 12%, and most recently 13% or so. And each time we've sold off these levels. So looking at the triple Qs, because they have more liquidity in the options there, resistance is around 290 right now. For tomorrow's OPEX, November 18th, current spot 282. Expected move is about 6 points or 2.1%. Upper expected move is 288. And lower expected move is 276 or so. Keep in mind we have gaps above at 310ish and a gap below at 263. So be very cautious here because we've seen these rallies occur only to be sold off very, very fast. And as I speak today, we're already dipping a little bit this morning. So I expect a lot more volatility. And
Nick, the one thing that just to cut you off here, buddy, the one thing that I agree with is that we've seen over the last 6 to 9 months these very short-term rallies that give back immediately. While I get your point there, I just don't know whether or not the whole market is ready for another round of selling just yet. And I'll be really curious whether it does sell off aggressively like you may suggest, or whether or not it's more of a trade range muddle for many weeks. Anyway, the one interesting thing, though, is that when we move on to volatility on page 5, is that, usually volatility contraction tends to be a good bullish tailwind for these markets. But it's interesting that the VIX has been incredibly stubborn around this 25 level. I mean, while we did have that little dip down below 25, it was very quick to get right back up here. And I was really thinking that during this kind of a rally sequence that we'd see volatility trade to the bottom end of its range, and it really has not. What do you make of this, and what levels are you watching on the VIX?
Well, yeah, Patrick, I've been watching the VIX for a while, and key support level is around 20, and a key pivot level I would say is 25, where if we get above that, you want to be very cautious on a run toward 30, and below that, obviously, we're going to pull back toward 20. But right now, the put to call interest is 0.25, which denotes that there are roughly 4 calls being purchased per put being purchased on the VIX, which is overall betting on VIX picking up in the coming months. So I expect to push toward 30, but let's move on to the dollar on slide 6. Eric, what are your thoughts here on the dollar?
Until last week, to my eye, the chart was showing a sideways consolidation between 110 and 114. Then last week, I said it looked like it was really developing a downsloping channel, but a shallowly downsloping channel. Well, this week, there's nothing shallow, and frankly, that channel was very clearly violated to the downside, confirming for the first time in my mind that the trend reversal really has occurred, at least in the short term. Now, I'm watching 104 on the Dixie, which is where the market found support in August, as the next support level. If that doesn't hold, and particularly if we break substantially lower, it would really confirm the trend reversal beyond any doubt on more of an intermediate to longer term basis. After 104, the next support level that I see would be the May lows around 101.
Yeah, Eric, you know what? That dollar move, the one thing I would observe here is, to me, we've been, or at least I've been quite adamant that a dollar pullback was inevitably going to come. This doesn't actually make me dollar bearish yet. I simply, such an extraordinary advance in the US dollar over the course of the 2022 year, inevitably rallies get checked. What to me, though, has been the part that's I'm still trying to kind of sort out is the depth and magnitude. I mean, we're already 10 Dixie handles off of the top, and it happened so rapidly. And the thing is that really, like the levels you're talking about, this kind of 104, 105, 106 level is just a stone throw away. And the bigger question is, will this correction ultimately be that? Will it be bought on dip? Will we start to see that the price level is being defended? Or is this actually something bigger? I'm not willing to stick my neck out that a major dollar top is in yet, but it's certainly the magnitude of this drop is certainly put a lot of question marks out there. Initially, a bounce here back to 108, 109 is actually a very typical reaction, and then it'll be really interesting to see how the dollar settles down for the rest of the year, and that's certainly something that we're watching.
Now, moving on to page 7, we have crude oil over here. What are your thoughts on this, Patrick?
Well, you know what? I'm actually quite surprised by just the lack of trend that has emerged in crude. And while we had some very bullish developing price action throughout the month of October, there was an even attempt for a big breakout attempt on crude back over there. And really since then, it just came right back into the pocket. And that doesn't make me bearish crude oil, but it certainly has lost a lot of the momentum it was trying to build throughout the previous month. It will certainly take it now a catalyst to really get some bullish momentum. I think the most important thing for bulls here is that they hold above those October highs and get the price back above 90 within a reasonable period of time. It's going to be an interesting feat to see whether they can pull it off. But at this stage, I think using even the $90 level simply as a pivot from which you kind of are moving from this neutral zone price action to a bull breakout is going to be a very clean round number to keep a close eye on. With that said, I wanted to move on to page 8 where we have that gold chart. Now, Eric, what are you watching on gold?
This rally has taken the market $170 or a little over that higher in just 8 sessions. And needless to say, that's incredibly encouraging for the bulls. It looks like we really have a sudden trend reversal and upside breakout that is now underway. But at the same time, we're way past overdue for at least some kind of technical pullback, and the slow stochastics are now rolling over from incredibly high levels, confirming that view. My best guess on what comes next is a pullback to about 1720, which is where the 100-day and 13-day moving averages are conveniently co-located. For those who are convinced that we're seeing a new uptrend, that would be the logical place to add to long positions. If that doesn't hold, 1693 looks like the next obvious support below that.
Yeah, Eric, I have to agree with you on some of those levels. For me, there was an extraordinary explosive rally, and no different than the sell-off in the dollar, which led to these kind of very similar breakouts in a lot of cross currencies, including the euro. And all of these are so on the short term overbought that they will do retracements. And I know you were talking about some of these levels in the 1700 area, and I think that that's where the gold pullback could arguably go. In fact, it would be quite bullish if the gold pullback could be held above 1725 or to the 1750 area. Overall, though, I continue to approach this will offer a buy on dip. And so as gold comes down into this pocket, it's going to be one of those areas where I'm going to keep a very close eye on how things are playing out.
And moving on to page 9, we have Sprott Uranium with a big red candle down. Now, what do you think over here, Patrick?
Well, up until yesterday's breakdown, it was shaping up to being a characteristically typical consolidation flag that often would have a bullish breakout. The fact that we saw such huge technical damage and some very heavy selling yesterday below the 16 level has done some real technical damage, and it certainly takes all of the wind out of the sails of the bullish uranium market. Now, one day doesn't make a new downtrend. The bulls could make a miraculous recovery over the next couple of days and get this north of 16 again. But if this sell-off that started yesterday ends up having any follow-through and it continues to maintain the weak price, it basically derails almost all of the bullish price action we've seen since the summer, and it will put uranium back into a far more neutral and trade-ranged price action, which would be very disappointing for a lot of uranium bulls that have been waiting for this to break out. But nonetheless, Nick, I wanted to wrap today's session by just touching on the 10-year Treasury yield. And obviously, we had this huge surge in interest rates, and bonds, the last leg of selling since the summer, has been one of the more vicious legs of this bear market decline. And we obviously saw interest rates hitting that 4.25 on the upside. We're now taking the pause. And what I've circled on these charts was simply the consolidation in the summer, which was also coming off of a pretty oversold bond market as rates were ripping up towards 3.5% back then in June. And it led to a multi-month pause and correction in yields as the bond market took a breather. And right now, there's no reason to believe that this is any different. I mean, it will certainly be quite a fundamental event on a macro scale if we suddenly saw some sort of disinflationary impulse drive bond markets to have something of a bigger rally. While there are certainly a number of pundits out there that are trying to make that call, but I think it's very early to be getting excited about bonds. I think that as we pull back to this 3.5% yield level, it's going to be a point where we'll really get some valuable information as to whether or not there's something more to this than just a correction. And that's certainly something that's on my mind.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.